is up, everybody? Welcome back. This is episode 9 of the Fresh Finance Podcast. My name is Thomas Elms. Got my co-host here, Kyle Ryan. Today, we are kind of doing a mid-May market update. There's been a ton of things kind of going on in the markets, going on the governmental regulation side of things that we just felt it was kind of relevant to kind of do another market update, talk about a couple of things, just kind of hitting on a couple of the major benchmarks, some of the major indexes or indices that are occurring right now, talking about housing, talking about interest rates, talking about some different bond-like alternatives that could be possible good opportunities depending on your circumstance. Kyle, just kind of firing off here. I mean, this has just kind of been a tumble down of a year per se in the market perspective. I mean, just kind of the notes that we put together. I mean, S&P's down about 17%, NASDAQ's down at about 26.5, mid caps down. Kind of looking at my notes, about 17, and then the small cap benchmarks. The Russell 2500's down about 23.5% year to date. Just a tough start to a year, and I just kind of my personal perspective here on the market as a whole is that I feel like, we've been kind of hitting on this interest rate conversation. And I heard a piece earlier this week that, I thought had some value, kind of talking about how rising interest rates play a role in earnings multiples for individual stocks and their performance. And I felt it was very interesting because as we enter into a rising rate environment, for the most part, earnings multiples, and what I mean by that is a company's ability to continually earn more, tend to go down, and so that's kind of decreasing expectations, which is normally tougher on individual stock prices. And I feel like just that paired with inflation has kind of been, one of the biggest punches to the market that we've seen, and then combine that with probably some, a too quick of a run up, mid COVID, kind of post COVID. And I feel like, that's kind of where a lot of our pain's coming from right now.
Yeah, I mean, there's no denying there's been a massive financial shock in the system, right? I mean, You could talk about the equity performance, but coinciding with, indices falling on the equity side, the bond market's doing very poorly too. The US ag is down to the tune of probably 10% or more right now.
Yep.
So there's really no safe haven unless you're, in energy and or commodities. I mean, your chances are you're down this year, right? So there's certainly no sugarcoating it. I mean, as you mentioned, this was April was the NASDAQ's worst month since 2008, even worse than March of 2020.
Yep.
The S&P 500 had its worst month since July of 21, I think. And it actually has its third worst start to the year ever for the S&P 500. So, you're getting hit everywhere. You're really not safe. And it's still, while everything's down, the moral of the story here is how far down are you? And it's really dependent upon where you're living in the equity world and the bond world. Because if you were 100% those stay-at-home, COVID stocks, those growth-oriented stocks, you're getting slammed right now. Mm-hmm. If you were, transitioning over to the value side of the equation, as you heard that interest rates were rising and inflation was looming, then you're still not happy dancing, but you're happier than you would be if you're 100% growth.
Yeah.
So it's really tricky right now.
Yeah, for sure. And just kind of on the housing side, just kind of pulling my notes up, but we're seeing the Case-Shiller Home Price Index just over the past year. That's up over 17.5%. So that's obviously an important factor to note is we've got rising interest rates, meaning for the most part, rising mortgage rates, and just kind of talking through that right now, the average 30-year, as of this month is, over 5.25%. Right. So, I mean, that's almost 200 basis points higher than what we saw in, 18, 19, 20. So that's a huge difference. And then, just kind of looking year over year on mortgage applications as well. I mean, that's definitely down, from where we've seen. I think we can, most likely attribute that to rising rates, and rising home values, and I mean, the outstanding loan right now, the outstanding average 30-year mortgage is about $450,000. I know, and one of the curious things that I want to look up or I'd love to see is, what outstanding average mortgage balances look like now in relation to '08, because I think people are trying to make a case, and people always do this, is, they're trying to make a case that this, resembles an '08 like situation, or, on the NASDAQ side, a 2000, tech bubble like situation. I think there's definitely some differences, and so it just kind of remains that time will only tell.
Yeah, and thankfully, the going back to the 2000s, as Alan Greenspan put it, that was irrational exuberance. Anything with a .com after its name was trading to the moon, as they say. And then 2008, you'd be hopeful that the subprime mortgages that were getting sold back then aren't happening now. But I know for a fact, because I was looking for a house in the beginning of 2020, your debt to income ratio, they're being pretty generous with being able to give you a bigger mortgage than you can likely afford. So there is a lot of fragileness out there in the system, but that being said, there's also a lot of strengths. And we've seen, as you mentioned, with the housing market, right? People are flush with cash. People have more cash right now than they ever have. So what are they going to do with it? If you've been living in an apartment your whole life, or you're looking to upgrade your house, you're going to go buy a new house, regardless of the housing market for some people. So, and not only that, so there's a huge demand for everything across the board right now. It's just supply is the issue, right? Look at the price of homes, look at the price of used cars. People want them, they just can't get them. They're willing to pay whatever they need to get them. Therefore, you have the prices rising, in ways we haven't seen in 40 years.
Yeah, for sure. Honestly, because I think that I saw the stat that we've, given back about, it was like 3 trillion or some number similar to 3 trillion in market losses year to date.
Yeah.
I mean, that's a staggering number. And, the thing to remember about that is, if you haven't sold, you haven't lost it, to a degree. It's just kind of reverting back. And sometimes I'll have this conversation with clients is, really think about investing as ownership, right? You're owning shares of the market, you're owning shares of a company, an individual company, and you're just trying to slowly acquire more shares of either good quality funds or good quality companies. Now, those shares are going to fluctuate, right? But you just have to understand your overall long-term process, and the fact that you're being a long-term investor, and understanding that, when you buy good quality, or you buy things that have good growth potential over the long term, they're going to perform really well for you.
Couldn't have said it better. It all comes down to knowing your story and the reason why you're investing. If you know you have to buy a house next year, well, in the beginning of the year, you said, well, my time horizon is a lot lower. Maybe I don't want to risk this money that I know I need to use. And, if you didn't sell out and if you didn't make it safe, look what happened to you now. But again, still going back, the biggest shock to me this year has been the performance of the bond market. You haven't seen a pull down like this in the equity indices as you have as in the US ag. I don't know if at least not in the last 40 years, you haven't seen a pull down like this. And it's really difficult for managing retirements. And, you have these people who, they have to take money from the account. That their time horizon is still quite long, but it's much more concerning when you're talking about money that you've got to live on, right? So that has been the biggest shock, at least to me, certainly, has been the joint pull down of both equities and bonds. And it's, where do you go from here? What are the fixed income alternatives that one can use?
And there's kind of two different methods there. The first would be kind of looking alternatively at something like a Series I bond. And I know that's something that you and I have touched on, offline, and there are some limitations as far as, how much you can put in at any one given time, per individual, and things of that nature. But, the Series I bonds are great when you really want to take advantage of, inflationary environments where we've got rising inflation, because they have some protection because of that. And so, the limit, and correct me if I'm wrong, is 10,000 a person per year. And not to, be negative, but kind of listing the con on the Series I bond, side of things is when we're in, I would kind of consider normal market conditions where we have traditional inflation, they're kind of a substantially underperforming asset. But in times like this is where they really thrive. And it could be a great kind of piece to a portfolio that has, a good amount of diversification, or, it could be that kind of diversifier in inflationary markets for sure.
Yeah. Yeah. Series I bonds are very interesting uses right now. I mean, they weren't really talked about much until probably 8 months ago.
Yeah.
In November, actually. November's when the inflation reading came out in the 7%. And today, as of May, if you buy a Series I bond, you can earn up to 9+%, at least for the next 6 months, of interest on your money. Of course, it's taxable, that interest, but it's a nice, safe, perfectly safe place to get a return. And as you mentioned, it has limitations. You can't put it in and get it out the next day. You have to hold it for at least a year. And if you sell it before it hits the 5-year mark of you holding it, you give up your last 3 months of interest.
Yeah.
So if you buy it for a year and sell it in a year, you only get 9 months of interest. You give up your last 3.
Yeah.
So, a Series I bond is, certainly interesting. Even kind of similar, you have TIPS.
Mhm.
TIPS are bonds that move with inflation, and pay a coupon accordingly. So that's somewhere that we've moved some money in our own clients' accounts. Because, if you're an investment grade bond, if you're in a long duration bond right now, you're getting smoked. You're down 10 to 11, 12% with who knows where the end is. The end, it seems to be in sight. If you're looking at the 10-year treasury right now, it bounced off the 3.3 range, the 3.3, and it looked like there was some support from the market. The market this entire time with the Fed going on, they've offered no support. They're saying the Fed will do what it does, and we are not going to come in and buy until there seems to be a ground. And it seems like that ground's been found, and the market's starting to give some support against the Fed's rising of interest rates, which is a little, it gives you a little bit of hope, but still tough outlook.
Yeah. And we kind of got a bit of a teaser, I would call it kind of a teaser to a punch in the gut. When Powell came on, and, kind of the big ticket item the first week of this month of May, was Powell came out and, essentially kind of ruled out the idea of a 75 basis point hike. And, the second he got done saying that, the market really rallied for the rest of the day. We brought back a lot of, kind of what we lost earlier in that week. And then the next day we start going right back down, just as hard. We basically gave it all back in a day. And that's kind of where, pushing into the idea of the leveraged and the inverse ETF and fund market, I think that's playing honestly a huge role, in some of these larger market swings. Is, a lot of these newer exchange traded funds or mutual funds that are 2 to 3x performance, and some of these categories are just making intraday swings much higher. I think that a case could definitely be made for that. Only time will tell how positive those types of investment vehicles are for the market. It's something that we aren't even allowed to recommend, actually.
Yep.
And so I think that that's kind of an important facet to understanding here. And retail options trading is through the roof right now as well. I think that that's playing a role, in kind of really spicing up these markets. And so kind of the culmination of all these things, I think, is the reality that we're seeing. And I think it's where kind of greed can sometimes come into play, as people are just trying to, like I always say, redline returns. And we're just kind of finding newer vehicles that allow us to do that. And we're also realizing what sometimes the downsides look like of possessing those vehicles.
Yeah, I mean, even in that same story, I mean, the rise of algorithm trading from the big wirehouses. I thought the circuit breakers were going to go on last Thursday or Friday, right after that news and the negative down day. You're down. Nasdaq was down like 5%. I thought it was going to be a circuit breaker day, because you have these algorithms that pick up trends in the marketplace, and they'll send signals to, basically, not to get too into it, but they'll send signals. They'll pick up signals in the market. They'll build upon trends, which will exacerbate those trends. And if you have enough algorithms that are saying sell, 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 all of a sudden you have a market that's going to collapse on itself just purely based on algorithm trading. So, I mean, that's what circuit breakers are, is that when the market hits a certain 7% down, it's the first one triggered. Circuit breakers jump in and basically pause it.
Mm.
But yeah, it's incredibly volatile right now. Option trading is at an all-time high because, premiums are absolutely through the roof for options traders. You get retail investors with margin all across the board that by now you'd think they wouldn't because they probably got margin called this year, but
Yeah, you'd think, but
yeah, but again, we sound pessimistic. There's a lot of positive things out there, right? So
oh yeah.
two-thirds of the economy is the consumer, and I can't highlight enough how strong the consumer is. We could talk about inflation and how it affects lower income households more so than anyone, but housing across the board, no matter what level of income you're at, is through the roof.
Yep.
Consumer spending, business investment spending they're all up since the beginning of the year, which being 2/3 of GDP growth, that's huge. It's easy to highlight the downsides of inflation. People called it transitory for a little bit. There's certain aspects of it that are, certain aspects of it that are here to stay. You got to learn how to work around it. But there's still, we're optimistic, at least in our shop here.
Yeah, absolutely. And kind of two quick things that I wanted to point out, and I really appreciate you bringing that up, is just because the conversations we're having are, kind of identifying the negative parts of the market, it does not mean we're pessimistic. And I think that it also doesn't mean that you have to or need to make changes to your portfolio, right? Being a long-term investor is always, we're going to go back to this, is buying things that are of value and, allowing them to grow and work for you. It's also really important to understand what is going on in the world, what is going on with the market, and, being able to internalize that and say, okay, this is the current market situation. Do I need to make a change or should I stay the same? Right. And just evaluating it from those points of view. And, as advisors, we really like to be on top of these things to, help calm the minds of our clients and ensuring them that they know that we know what's going on, and that if action needs to be taken, we, have the ability to actually know what actions to take. And I think that's just really important. And, because the bottom line is, a lot of these things, especially for young investors, you just kind of have to turn the noise off, and you have to continue to, buy things that are of value and allow them to grow. And honestly, on the fixed income side, I just didn't really bring this up, but I was talking with, our team president actually, about 20 minutes ago, about kind of the fixed income market. And he said, you just watch, give the fixed income market 3 to 6 months and allow it to kind of get to a place where it can catch back up to where rates are, and where treasuries are right now. And just allow that to recover. And he, kind of his contention is he thinks that, you're going to be pleasantly surprised about, how recovering, fixed income portfolios or fixed income funds, will recover here, most likely quicker than the equity side. Just kind of depends.
You almost want to ask yourself, how much further down could bonds go? I mean,
Yeah.
bonds, there's still a lot of quality in bonds, and their yields. I mean, geez, their yields are through the roof now. I
Yep.
mean, what happens when a price goes down of a bond is the yield that's out, what it spits out goes up,
Yep.
right? And the vice versa happens. So bonds are producing more income than they were before, and they're cheaper to get now. I'm pretty bullish on the bond market as well, because again, we have a healthy economy. It was just consumer and investor sentiment is so low right now.
Yep.
What they always say, buy on fear, sell on greed. There's a lot of fear in the marketplace right now.
Yep. Absolutely. This is a great time to, if you've got inflows of cash to get in the market, to get diversified, and get it kind of primed and ready for the run back up. Obviously, we don't know when or how much that will look like. But this is a good time to put money in the market, especially if you've got a long-term time horizon with it. And it's a good time to maybe be either rebalancing or trimming some winners, or maybe buying in on maybe some shorter term losers that you like. And just kind of stay in the course.
Yeah. And the last thing I'd say is, in a market downtrend like this, it's always better to leak in than jump in.
Yep.
As you never know, like you said, we don't know where the bottom is. We don't know if we've seen it yet. But you want a dollar cost average your way into something rather than jumping all in, because you might regret it.
Yeah, absolutely. And this right now is the exact interpretation of why you dollar cost average, right? Is you're essentially catching different price points in the market as situations evolve, right? And it's the same that goes for when we actually kind of go on the flip side and we start to recover, right? As you want to slowly buy in as the market continues to grow, so you kind of have a diverse, what we would call a cost basis. So I think we covered a ton of really good material here. Kyle, do you have anything else?
That was it. Short and sweet for us.
Perfect. I love it. Well, hey, thank you guys for listening. Thanks for watching. Really appreciate it. And looking forward to you guys seeing the next episode. Catch you later.